Three major events that happened in the first 3 days of May may influence the direction of the housing market. Two of them were widely covered in the news, one wasn't. Nevertheless, I want to make sure you are properly informed. Number one, on May 1st, First Republic Bank officially failed and was acquired by JP Morgan Chase. Similarly to the Silicon Valley Bank failure, the collapse of the First Republic was triggered by the combination of outflow of the deposits with deterioration of the market value of the bank's investments. As First Republic's portfolio of low-rate mortgages became unprofitable in today's high interest rate environment, clients withdrew 40% of the bank deposits. It was the second largest bank failure in the history of the United States, and it reignited worries about the stability of the banking system, and regional banks specifically. In the aftermath of the First Republic Bank acquisition by Chase, shares of Los Angeles-based PacWest Bank and Phoenix Western Alliance were affected the most in the early week trading. Number two, also on May 1st, new Federal Housing Finance Agency mortgage rules came into effect. The new rules increased the fees for some borrowers while decreasing them for others. They also created two new high credit score categories, from 760 to 779 and from 780 or higher. At the same time, the lowest credit score range from 620 or lower was bumped up to 640 or lower. I'm including a link to the loan level price adjustment matrix released by Fannie Mae in the description of this video. If you were recently pre-approved and you are actively shopping for a home, I would recommend you talk to your lender to confirm your borrowing limits, your expected monthly mortgage payment, and the applicable loan costs. Number three, on May 3rd, the Federal Reserve announced another 25 basis point rate increase, pushing it above 5% for the first time since 2007. The rate increase was widely expected, but everyone was waiting for any indicators of the future direction of the Fed's policies. To avoid disappointment, they kept the option of further rate hikes open depending on the impact of previous rate hikes on the inflation and the economy. During the press conference, Chairman Powell said, and I'm quoting here, "A decision on a pause was not made today." All three of these developments will reduce the money supply and affect availability of credit for the home buyers. They potentially may change the direction of the housing market. Now, let's shift attention to what is happening in the Bay Area. The biggest problem here in Santa Clara and San Mateo counties is inventory, availability of homes for sale. The number of new listings in April fell by 30% compared to the same time last year. Because of that, the number of new contracts ratified in April declined by 30%, just like the number of new listings. At the same time, the number of closed sales dropped by a whopping 50%, again year over year. The Bay Area is disproportionately affected by this market slowing trend. Nationwide, the number of new listings dropped by only 20%, according to Federal Reserve economic data. Active inventory, the number of homes available for sale at the end of April shrunk by 12.2% compared to April of last year. The demand remained strong, however. The median time on the market was only 9 days, which means that half of the homes that came to the market sold in 9 days or less. In comparison, it took 10 days to sell a median home in March and 12 days in February, an accelerating trend. Low availability of homes for sale and high demand continued to push the sale prices up. While April median home sale price was 7.8% below the last year level, it grew by 14.4% since the beginning of the year and by 4.8% from March. Current housing prices are right between 2021 and 2022 levels, 7.4% above April of 2021 median home sale price, and, as I already mentioned, 7.8% below 2022 level. If you are thinking about selling your home, it may be one of the best times in recent history. The prices are very close to the all-time highs, and with so few homes on the market, you will have very little competition. We are still in a strong seller's market. The Bay Area has only 1.6 months of inventory. Inventory should grow to 6 or more months in order for the market to become a buyer's market. As for the buyers, don't get discouraged. There are always opportunities on the market. If you are thinking about buying a home this year, or even in 2 or 3 years, click on the link in the description of this video to connect with us. Let's get together in person or on Zoom to go over the buying process from the very start all the way to the day when you get keys to your new home. We will also cover topics you need to know as new homeowners. We will talk about the hidden inventory, ways to estimate market values of homes you are interested in, and how to make your offer stronger without going all out on the price. This is Michael Tallis with the Tallis team. With major developments happening daily, if not hourly, I will stay away from predicting the next housing market move. I will continue, however, to monitor and report on all the latest trends. If you found this video useful, support us by clicking on the like button, subscribe to this channel, and share this video with other people who may enjoy it.